Welcome to the Property Profits Real Estate Podcast, the show where real estate investors talk strategy, capital, deals, and growth with your host, Dave Dubeau.
Chances are you've heard once or twice you should diversify when you invest. The question is, if you're a real estate investor, what the heck does that look like? What is this infamous diversification? Well, today, zooming in from Florida, we've got a very, very experienced commercial real estate investor. Lon Welsh has been in the business for over 20 years. He's written books, he's worked with people, he's raised capital, he's operated, he's got all sorts of deals on the go. And today we're going to talk a little bit about what diversification means to Lon. So welcome to the show, Lon.
Thanks for having me today.
My pleasure. So before we jump into that, give us a little snapshot of what you do in real estate. So what are you investing in primarily in 2026? What does a portfolio look like? Let's just start with that, if you would.
Yeah, our two primary products are we've got an income fund that pays 11 to 13% with quarterly dividends and pretty decent liquidity. That's been the majority of the fundraising because people are uncertain about where to invest and they want maximum liquidity. Lots of people are choosing that. And then we've got a flagship long-term investment fund in commercial real estate, and we'll talk a lot about how we approach diversification on that on today's show, I bet.
Okay, so in the big picture, are you primarily a capital raiser, a fund manager, or an operator?
We're not an operator. We raise capital for the long-term fund that we invest with general partners who have really good local knowledge, but we don't operate very many of them ourselves. Occasionally we will, but that's rare.
Okay, very good. So have you been in the capital raising business primarily since day one, or did you switch kind of from operations into that?
Yeah, I was just investing for my family and I for the last 24, 25 years. And as I had more interesting opportunities after a decade or so, occasionally I'd bring out a couple people outside to invest with me, which kind of taught me how to build all the syndication documents and how to explain things to a bank in that sort of format. And I had enough people eventually asking me, can I invest with you? That I thought, you know what, I may as well set up an investment fund to be able to do this. So that's kind of how Untitled Capital got started. So really our first 250, 300 investors were all people I've known for a decade or more. And now we're getting a lot of other referrals in addition to that, which has been really gratifying.
So what was your business outside of real estate where you made all these connections?
Oh gosh, I started a brokerage called Your Castle Real Estate in Colorado, which eventually grew to be the largest independent brokerage in Colorado. We had about 750 agents. So I've been teaching classes on real estate investing for a couple of decades. And for every 20 people I'd have come into a class, I'd have one person buy an apartment building with me and 19 people who said, I'm a really busy architect. I've got kids at swim lessons. I don't have time to do this, but I love the thinking on it.
Smart. So you taught them what a pain in the butt real estate investing can be, and they said, "Hey, take care of it for me." Smart.
You know what? If I was really smart, I would have done this 20 years ago because I had 19 people in the room who said yes to that, as opposed to 1 out of 20. But eventually, I figured it out.
Well, hey, better late than never, for sure.
Right.
Okay, good. Well, thanks for giving us a little bit of background there, Lon. So tell me a bit about the diversification side of things, because over the last few years, multifamily has definitely taken a bit of a kicking. It keeps on chugging, but some people have been hurting that field. So what does diversification mean to you and your investors?
So what we structure for our long-term fund is really DNA of diversification that all of your listeners could probably also benefit from. Whether you do it yourself or we do it for you, it doesn't really matter. So in one of our typical funds, what I'd like to have is about 40 different assets. Ideally, I'd like to be in 8 to 12 different states. And then the diversification methods that we look at are, first of all, asset class. So usually about 2/3 of what we invest in will be multifamily. The rest will be, there's a couple segments of hospitality, and I can drill into that later if you want to. And we'll occasionally look at self-storage. We're very specific about that. And then industrial fills out the rest of it. From a strategy standpoint, there's really 3 ways typically to make money in commercial real estate. You can do a buy and hold where you pay a higher price for an asset that's clean, ready to go, cash flow from day one, not much risk. We don't do any of that. If that's appealing, something called a real estate investment trust, a REIT, is probably the right vehicle. And I can talk about how to pick one of those if that's of interest to your audience. We like the other 2 strategies. So one is to build something from scratch, new development. We love that. That's usually about half of what we do. And then the other is to do a value add project to something that's been neglected, needs work, poor management, deferred maintenance, or whatever. Partnering with someone who can go solve all those problems, we can usually buy it at a very attractive price and capture a good spread. So that's the strategy diversification. Geography, we like to work in states that if you don't pay the rent, you have to leave. That sounds like common sense, but common sense and common practice politically are not always the same thing.
Well, yeah. I'm Canadian. I'm very familiar with it not being common sense. But anyhow, yeah.
We may have the same legislatures working for both of us, unfortunately. And then lastly, sponsor. So what you find over time is that every sponsor has got their own portfolio of strengths, and they'll have their own blind spots. And if you're investing yourself as you being the operator, that means you're the sponsor as well as you're the investor, and you've got your own blind spots. So that's always a little bit dangerous. So an example might be if you had a lot of rental properties in Colorado, there's been 14 pieces of legislation in the last 3 years that were all hostile to the landlord, very friendly to the tenant. That's made it very hard to do business in the state of Colorado. And if all of your rentals were in this one geographic bucket, you've got some exposure to a frustration that you probably didn't plan on when you bought all those. Yeah. And from a sponsor standpoint, your methods of dealing with that legislation might be the same. Well, there might be some loophole that a tenant could use to take advantage of you now, and you'll have that weakness exposed across your whole portfolio. So sponsor diversification is actually something that people very infrequently talk about, but is actually also very important.
Yeah, no, that makes a ton of sense. So different assets, different locations, different operators, sponsors, spread things around. So you mentioned a couple of things that I find really interesting, Lon. One is that you're really bullish on development these days, so building from the ground up. The other one is value add. Now, I've been talking to some sponsors and operators lately, and some of them are saying, you know what, it's a tough environment to build from the ground up these days just because of costs and interest rates and vacancy rates and all this kind of stuff. And then also some other ones saying, hey, it's tough to do value add or find really good value add properties, kind of because of the same reasons. Like just maybe you get them, but then fixing them up because it's way more expensive than it used to be. Getting them at reasonable prices, it's kind of tough. So where are you guys finding the sponsors that where these kind of deals are still working well?
So the new development side, there's a lot of little industrial sleeves here and there where adding in a multi-tenant warehouse makes a ton of sense. So
yeah,
if you take a look at a large distribution center for like an Amazon or a Target, that'll be maybe 1 million square feet or larger. So there's been a lot of focus on building that. And there's a little bit of a glut of that size of space in a lot of metro areas today. When you look at multi-tenant for the people who just have a need for maybe 150, 200,000 square feet, and you're going to have like maybe a 750,000 square foot building with like 4 or 5 tenants in it, that's been undersupplied in a lot of geographies. So what we try to do is not look at just the generic supply demand balance by geography, but we try to disaggregate it by which part of the city are you in, and then for the size of the user. So for example, in Phoenix, generally speaking, a little bit on the overbuilt side for industrial, but things that are closer into where the cluster of most of the manufacturing is, there's not a lot of opportunity to build new warehouse. So we have an opportunity to put one in. We thought that was fantastic. And we were able to do a multi-tenant, and there was like almost nothing coming online in, say, the 150 to 250 range. It was just the perfect, every once in a while you find like the golden thing, and this was that. Yeah. So on the industrial side, that's what we look at. For hospitality, the extended stay segment of hospitality comprises about 19% of the room nights in America, and yet only about 11% of the hotel inventory of America. So it's a real big supply-demand mismatch. So there are mid-sized markets where there might be just one extended stay, but there's demand for a second, but probably not enough for a third. And if the incumbent is 15 to 20 years old, if you go to the new property, and if you can support it with the average daily rate, the ADR that's in place in that market today, and pencil it out well, you're going to cremate this other guy because you've got like an old stale product. So doing rifle shots of hospitality within that, we like the budget segment because most budget extended stay is not elective. It's mandatory. We could talk about that for 10 minutes if you're interested, but let's just be quick. On the multifamily side, we like to focus on workforce housing. So the majority of the new stock getting built is luxury and double luxury property, pet spas and all these other things. The challenge is that in a lot of metropolitan areas, if you're a nurse or you drive an ambulance or you're a school teacher, nobody's building a product for you. So we've got a couple partners that we've invested in that are very effective at building that type of product. And we can talk about that whole strategy and the geographic selection. But what we're delivering to is we're underwriting, taking a look at the Class B properties that are 20 years old, taking their rents. And if we can get to an attractive cap rate on new construction, serving that middle market, that's a go, because it's the same thing. We deliver a new product, we're going to decimate the incumbent with an old stale property. So long answer to a short question, but it's very
that's the answer I was looking for sure.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com.
Okay, so Lon, in your business, correct me if I'm wrong, but there's like two main things you got to focus on. Well, more than that, but two big buckets. Bucket number one is finding good operators or sponsors to work with. Bucket number two is finding investors for the fund to create funds to invest in these deals. So let's take a little bit more of a look at the operator sponsor side of things. What are you looking for? Well, you kind of mentioned it, but what are you looking for in sponsors? Like, are you kind of dialed right in? Have you got all the sponsors that you could ever want and you're not looking for any more? Or are you always looking for new sponsors and new opportunities?
I'd say for a given long-term fund, we've usually pre-populated about half of the investment slots from existing sponsors, but we're always looking for new people, particularly if they've got an investment thesis that just really makes sense. So there's probably someone on your show that's got an industrial opportunity somewhere that we need to hear about, so I hope they'll reach out to me. But beyond that, it's really just all the standard things. We're looking for people who've done it a lot of times through a full market cycle, and that they're working in geographies where they really know local planning, zoning codes very well, that they can help us peel the onion on the supply-demand balance in that market for that slice of the asset, very fine-grained, and that they're used to coming up with problems on projects, and they've got a pretty big arsenal about, here's what we're going to do to solve this, here's what we're going to do to solve that. Probably the same thing that all the rest of your other guys look for, but we just ask a lot of questions. I've been doing this long enough. I've been burned in so many different ways. I just try to make sure I go through the whole list.
Well, hey,
there's always a new way to get burned, but you just do your best.
Yeah, so you just try to remember and not get burned twice, that's for sure.
Yeah, right.
Not the same way, at least.
Yeah.
I can relate to there, Lon. So let's talk a little bit about the investor side of things, because I've interviewed a number of capital raisers recently, and especially on the multifamily side of things, it's a little tough these days compared to in years gone by. What are you seeing out there when it comes to finding investors, getting people interested in real estate? Are people a little gun shy, or is what you're showing them with this diversification appealing? What's your take on the pulse of investors these days?
Yeah, it's a really good question. So there's a couple different segments that we serve. So for the people who have got a track record in investing with real estate syndications, or people like us, they're not investing at a very fast pace right now for two reasons. A, they might be gun shy. Everyone says that they're contrarian investor until they got to write a check at the bottom of the cycle, and that's where we're at right now. Mm-hmm. But the larger problem is that these people still have the appetite and the desire to be in commercial real estate. But like me, they've got a lot of investments that they thought were going to be a 3 to 5 year investment that now is going to be a 5 to 9 year investment. And the projects are working fine, but it's not a very good time to sell. So the capital's still tied up. Right. So, they would write us a large check today as soon as they get 2 or 3 of their old projects to mature and return the capital will be where they place it next. Mm-hmm. So those two drivers about fear of the market cycle and capital illiquidity are the two big problems. Other segments are different. So the other two segments that we tend to help a lot are what I think of as like entry-level accredited professionals that are like, say, to 1 to 5 million net worth. They're a busy architect, attorney, doctor, dentist, and they've got all their money sitting at Vanguard in stock and bond funds, which is excellent. but they realize they need to diversify into real estate. They don't want to be one of the 19 people in my class who buys an apartment building themselves. That just sounds like a lot of work, and they're too busy already. So we help them to diversify with the easy button. That's a big sleeve. And for most of them, they're not already in commercial real estate. So for them, it's still like a green field. The last segment has actually been a huge one for us, is that in Colorado, I've got well over 1,000 people I've helped to buy investment property as an active owner. And the changes in the laws and just people getting older has driven a lot of them to say, you know, I've slain enough dragons. I'm done being a landlord. I want to sell my property, and I still like real estate. I just don't want to be responsible anymore. So we have lots of escapees from active management on our roster. Long answer to a short question. So they've all got a different psychology, each segment.
Yeah, you got 3 different buckets that you're really going after. So the traditional multifamily LP, maybe not so much right now, but I really like what you're talking about there. Well, the frustrated landlord or the burnt out landlord drank the Kool-Aid about real estate, knows it works, just doesn't want to work it anymore. And entry-level accredited investors. I like that terminology very much, Lon. That's what I often recommend to people is, don't go back to the same well of burnt out LPs who've lost money on deals, or if it's done for a while at least, right?
24 months from now is going to be great again, but not for a while.
I mean, now's the time they should be investing, but hey,
many have the desire, they just don't have the liquidity.
Exactly.
So it's about building trust-based relationships in the interim. So if you can offer an income fund or some other liquid product where they can take the money out and redeploy with you as an LP when they feel the time is right, just build the relationships. Well, people lose track of the fact that we're in the business of selling trust and relationships. We're not in the business of selling real estate. So if you can focus on the right thing, you're going to be a lot more successful.
Yeah, you're absolutely right there, Lon. No, that's great. So as of the time that we're recording this, it's just about the end of May 2026. Where do you see things going with you and your funds over the next 12 to 24 months?
Well, the University of Michigan does this great study of consumer confidence, and then they released the results yesterday, and we're like at a 40-year low for consumer confidence. So those people are not going to be too excited about either buying a house or writing a check to invest in a real estate fund anytime soon. So I think what you want to do is keep that part of your business as warm as it can be, but I wouldn't overemphasize. I would grow relationships with other products, stay abreast of the market. Eventually, the things that are weighing on consumer confidence will blow by and things will come back. Honestly, this reminds me a lot in the Denver market of about 2009 to 2011. Denver was the first one to have the big housing crisis between 2007 and 2009. Other states followed behind us because their foreclosure cycle is a lot longer. By 2009, it was very clear that if we weren't at the bottom, we were within a rounding error of it. So entry-level condos had dropped about 65% in value. So we were running a lot of classes showing an analysis. I won't bother you with all that. It was a great time to buy. Most people wouldn't take advantage of it. And then by 2011, they said, you know what? I should have bought in 2009, but I'm ready to buy now.
Yeah,
that's great. It's still going to be excellent, just not quite as excellent.
Right.
We're having I feel a rhyme of history right now with that.
A little deja vu, huh?
Well, I'm not being frustrated. I've been through this movie before. I know how it ends. I just have to be patient.
Yeah. So true. Awesome, Lon. Well, this has been a fun conversation. I'm sure there's going to be some people listening or watching this who'd like to connect with you. What's the best way for them to do that?
Go to our website. It's Ironton Capital, IRONTON, capital.com. And if you go to /property profits, just like the name of our webinar that we're on here today, you can get a hold of me. You can download our book on passive real estate investing for free. So if you've thought about doing this, but you're not even sure what questions to ask, what due diligence to do, who should be on your team, how to explain it to your family, this book has all of that. And it's a great resource.
Awesome, Lon. Well, hey, thanks so much for being on the show.
Thank you for having me.
My pleasure. All right, everybody. Thanks for tuning in, and we will see you on the next one. Take care.
Thanks for listening to the Property Profits Podcast. If you'd like to be a guest on the show, apply at daveinterviews.com.